capital budgeting process. Okay? And capital budgeting, we are talking about the investment decision. Okay? So, well, we're going to talk about this topic, related topic, in a few future chapters, in the following chapters. Okay? But in this chapter, we're just laying some foundation on how to approach, right, this investment decision. Right? And in the next chapter, in chapter 10, we will talk about details, methods of evaluating and actually making the decision and choosing one of the alternatives. Okay? All right, so today we're going to talk about net cash flow mostly, okay? How to assess and predict the future net cash flow from this investment alternatives. Okay? So I think at the end of last class we were talking about these points, and the first one was the should be measured on an incremental basis. Okay? Again, incremental basis means you have to compare the case with the project to the without the project. Okay? So what's the actual net difference in the cash flow this project makes? Okay? That's what we mean by incremental basis. Okay? And in a few slides later, we're going to use this actual equation to talk about that, right? But here, for example, this RW minus RWO means it's a revenue with the project minus revenue without the project. Okay? So suppose you're thinking about one potential project, okay? And by going through this project, undertaking this project, you expect, say, $1 million revenue. Okay? And so without this project, your total revenue would be, say, $500,000, right? Then the difference is $500,000, right? That's the incremental base. That's what we mean by incremental basis, right? So what's the net difference does this, this project makes, okay? All right. The second point is cash flow should be measured on an after-tax basis, because tax is an important consideration, right? Tax makes difference in your profit, okay? So you have to consider tax when you evaluate any project, okay? All the indirect effects of a project should be included in the cash flow calculations, okay? Especially, we're talking about usually changes in net working capital. Net working capital. Okay? What is net working capital? Does anybody still remember from the first course? Yes. I'm sorry, what?
Current assets minus current liability.
That's right. Current asset minus current liability. Okay? And what are the items in current assets? Yeah, okay. Cash. Accounts receivable, yeah, account receivable, right? And inventory, yeah, something like that. Accruals, right? Yeah, right. Okay. Current liability, the accounts payable, the notes payable, tax liabilities, and so on. Okay? So we're talking about short term, right? When we say current asset, current liability, we're talking about 1 year or less than a year, right? So something that you can use within a year, which is immediately available, right? Well, immediately or within short period of time, right? The liabilities, something that you expect to pay within a year. Okay? 영현? Yang? Hanru? Are you? Hanru? Okay. Were you here in the first class when we went over the syllabus? I told you something about the using the cell phone or texting in the class, right? Oh, you're checking the dictionary. Okay. All right. I understand. Okay. Just wanted to remind you because apparently so many people missed the first class. Okay. Okay. All right. So the difference between the current asset and current liability is net working capital. Okay? And sometimes when you start a new project, okay, you need to make some adjustment in the net working capital. Okay? For example, because you are starting the new project, you need to have a little more cash cushion. This project brings some uncertainty in your revenue situation, right? So you may need to have a little bit more cash reserves, right? Or sometimes you need to increase the account receivable, which means, you need to extend the time for your customers to pay back or pay for your output, for what you have sold. Okay? Or sometimes you need to increase the inventory level, right? Because of the new project and so on, right? So when these things, you have this kind of needs, right? Then you need to consider that as the part of the new project, the cost of the new project. Yeah. All right. The sunk costs should not be considered. The opportunity cost should be considered. Okay. Yeah, this is a simple economic principles. Sunk cost. What is a sunk cost? What do you mean by sunk cost? Yeah. Right. So on any expense that you have already made, right? And when you make any business decision or investment decision, forget about what you've already spent. That should not come into picture when you make the decision. Doesn't matter how much money you already spent, right? A typical example that we use is Concorde, supersonic jet. How many of you know about this supersonic jet, Concorde? Nobody? Yeah, let me show you just a list. Beautiful airplane, okay? Supersonic airplane. Okay? And they built these during the 60s. Okay? As a joint project between England and France. Okay? And they spent so much money developing this supersonic jet. Okay? And I think they started flying actually probably late 60s or early 70s. Okay? And they flew, it operated about 25 years, okay? Until early 2000. Okay? Maybe about 30 years, okay? And they stopped operation. Okay? It doesn't fly anymore. Okay? They built a total of 20 of these airplanes, but 6 of them were kind of prototype, okay? As a test flight. Okay? So between the British Airways and Air France, each company had 7 of these airplanes. Okay? And obviously, this is a huge project, and it cost a lot of money, and it also took many years to develop this airplane. Okay? And in the middle of development, they realized that this is not going to be profitable, okay? Because it's, in order to go so fast, you have to make the body very, very narrow, right? And so the total seat capacity is only 100. Okay, you can seat only 100 people, okay? And it burns so much fuel, okay? To go to the, I think it's a Mach 2, okay? Twice the speed of sound. Okay, so I think it could fly between London and New York within an hour or so. Right? I think there was a movie. Some movie. You guys talking about which movie I'm talking about? I forgot about them. Yeah, anyway. So, please turn it off. That vibrating sound bothers me. Okay. So there was a commentary on the London Times. Okay. Apparently there was a lot of debate whether they should continue with this project or cancel the project in the middle, right? But the London Times commentary said, well, after spending 500 million pounds, okay, it's too late to cancel this project. Okay? Well, we were talking about 40 some years ago, so 500 million pounds was a lot of money, okay, I guess, at that time. Okay? So they went ahead with this project and completed, building the total of 20 planes, okay? And they operated for the next 30 years. Okay? And during these 30 years, they never made a single dime. Okay? Every year, it was loss, negative profit. Right? And finally, there was a crash I believe, in 2000. Okay? So around 2003, they stopped operating this beautiful airplane, right? And while it was flying, I think each ticket cost almost $1,000. I'm talking about $7,000 between the New York and London just to fly between. So it was, and still they could not make money out of this airplane. Okay? So what matters is from now on. From this moment on, will it be profitable? Right? That's what matters. What you've already spent, right, should not matter or should not come into picture when you make any decision, investment decision. Opportunity cost should be considered, right? What do you mean by opportunity cost? Yeah. Right. In other words, what you need to give up. What are you giving up, right? When you choose one alternative, what are you giving up? That's the opportunity cost, right? Obviously, it should be considered exactly. Okay? All right. So here's we're getting into a little more detailed discussion. Okay. Here. Okay. Net investment, NINB. Usually we write it as NINB. Net investment. Okay. The way you calculate the net investment is the new project cost plus any installation and shipping cost. So suppose you are installing new equipment, right? And not only the cost of the equipment, but the shipping charge and any installation cost should be also considered. Okay? And then to that, you have to also add any increases in net working capital initially required as a result of the new investment. We talked about that, right? If you have to increase inventory, the cost of additional inventory should be added, right, as an initial investment. Okay? Sometimes when you purchase the new equipment, you need to provide training, okay, for your employees, right? And that training cost should also be included, right, as a net investment. Okay? From that, you have to subtract net proceeds from the sale of existing assets when the investment is a replacement decision. Okay? So you can think about two different cases. The first case is you are purchasing a completely new equipment. You didn't have it before, right? Then you don't have to worry about this. Okay? But sometimes or many times you replace existing equipment, right? Then, well, perhaps you can sell the existing equipment in the market, right? And so that proceed from sales of the existing equipment should be subtracted from the cost, okay? Because you are recovering part of the cost. Okay? And then finally, the taxes associated with the sale of the existing assets and the purchase of the new assets. Okay? So we'll talk about this in detail in a few minutes later. Okay? But depending on how you depleted or depreciated the existing equipment, right? In other words, what is the book value? Okay? Suppose you paid the $10 million. That was the purchase cost of the existing equipment. Okay? But you used this equipment for the last 10 years. Okay? And over the 10 years, you have depreciated $8 million. Right? Then the book value of this equipment is $2 million, right? You still have $2 million remaining, right? Sometimes, so book value is $2 million, but in the market, actually, right? When you sell this existing equipment, you can sell it at $3 million, right? Then you have that's $1 million over depreciation. Okay, you have depreciated this equipment for $8 million, right? But in fact, you should have done it for only $7 million because current market value is $3 million, right? Then you owe taxes for that difference, $1 million difference, because when you depreciated $8 million from the existing equipment, you had the tax reduction. Okay? Your tax liability was reduced for this $8 million. Okay? So, in fact, if you can sell it at $3 million, right, then you will have to pay taxes on that difference, $1 million benefit. Okay? We'll see more exactly using the numbers in a few minutes. Okay? All right. Sometimes the NINB or net investment is done or made over some multiple period, multiple years. Okay? So instead of spending all the money on one year, right? This investment project requires investment over 3 years, right? Then how do you calculate the net investment? Well, you have to calculate the present value, right? So in this example, actual cash outlay is $100,000 in the first year, $30,000 in the second year, and well, you can say $100,000 immediately today, right? And within next year, you need to spend $30,000, and within the next year, right? So during the second year, you need to spend $20,000, right? So if you discount to calculate the present value of these cash outlays, you come up with the $27,270 and $16,520, right? So when you calculate the total present value, right, of the investment, that's $143,790, right? So you can use that as the NINB, net investment. Okay? All right, so ultimately what we are getting at is the net present value. Net present value is net cash flow minus NINB. Okay? So what we're talking about is here, initially, in the beginning of the project, you're going to have to invest certain amount of money, right? That's NINB. Okay? All right, let me refresh your memory. The way you draw the timeline, the down arrow indicates cash outflow, right? And up arrow indicates cash inflow, okay? So let's say you invest certain amount of money today and you expect cash flows over next few years, okay? So, well, let's say you can say, yeah, net cash flow 0, net cash flow 1, 1, 2, 3, and so on, right? Ultimately, you'll have to discount all these future cash flows, okay? And so that's going to be the present value of net cash flow, okay? And when you subtract NI and V from the present value of net cash flow, that's going to be net present value, okay? And how do you use net present value? Once you calculate the net present value, what do you do with it? In other words, why do you need net present value?
Select which project is profit.
Okay, so how do you use net present value? Yeah. So if net present value is positive, then the project is worth undertaking, right? And if it's negative, obviously you're not even recovering your cost, initial investment, right? So you should not invest in that project, right? When you have multiple projects, what are you going to do? Yeah? Take the one with the highest. If you have, rationing situation, in other words, if you don't have enough fund to cover all the project, right? If you don't have, if you're not facing the capital rationing, what is the, yeah? Invest in all the projects that have positive net present value, right? That way you are what? Maximizing, right? Maximizing shareholders' wealth, right? In the beginning of the first course, you should have learned what is the goal of the financial management, okay? Corporate finance, right? Ultimate goal should be what? Maximizing shareholder wealth. Okay? All right? Okay. All right. So that's the idea. Right. So here's exactly how we calculate the net cash flow. Actually, right now, we're talking about net cash flow for each period, right? It's change in OEAT. Okay, what is OEAT? Right there. Change in operating earnings after tax. Operating earnings after tax, right? Plus change in depreciation minus change in net working capital. Okay? Well, it shouldn't make too much sense at this point, okay? But here's more detailed calculation of this first equation, right? So OEAT, operating earnings after tax, is calculated by this first line here, right? So the additional revenue that the new project generates, I already explained it, right? RW minus RWO, revenue with the project minus revenue without the project, right? That's the incremental cash flow from the project, incremental revenue, right? Change in revenue. And here, OW minus OWO is operating cost or operating expense with the project minus operating expense without the project, right? So obviously, when you run another project, there will be operating expense, right? So what's the incremental basis? What's the additional amount of operating expense when you run the new project, right? So you have to subtract it from the revenue, right? Yeah.
Software depreciation
Hmm?
do you do minus in depreciation?
What slide are you talking about? 11? Yeah, this one?
This one.
Okay, and what?
On top of the page,
Yeah.
on the print, you say we should plus depreciation, but
Right. Here, the change in depreciation. This one is actually here. This one, the change in depreciation. I know it's strange because you subtract this thing here and then add it back here. I'll explain it. Okay. Give me a few seconds. Okay. So as I said, this first line here, right, starting from here to 1 minus t here. That's this first term, change in OEAT, right? Change in operating earnings after tax. Okay? So what we're doing here is from the revenue, we subtract the expense, and then we subtract also the change in depreciation, right? So because of the new project, suppose your depreciation went up by a certain amount, right? Then you subtract that, okay? I mean, that's a typical process when we calculate the operating income, right? Like EBIT, EBIT, right? From the revenue, you subtract expenses and then subtract depreciation, okay? Then you come up with the amount of income you have generated, right? On which you owe taxes, right? So here we multiply 1 minus t. T is the tax rate, right? So if let's say your tax rate is 40%, 0.4, right? Then you are multiplying 0.6 here, right? So because whatever you have generated here, that's the income you have generated, right? But you cannot keep the 100% of that income because you have to pay income tax, right? So you are multiplying 1 minus t. So you get to keep 60% of the total income generated here, right? Okay? So depreciation here actually reduces your tax liability when you subtract the depreciation from your net income. When I say net income, I'm talking about this difference, right? Revenue minus expense, right? Or you can say it's a net sales, right? So from the net sales, you subtract the depreciation because your tax liability, you don't owe the taxes on the amount of depreciation, right? Right? Okay. Sorry, this is my ragweed allergy season, and when you take this allergy medication, you get a little bit drowsy, right? And can't think of some words, better words, right? What do we call them? Tax exempt, yeah, right. So the depreciation is tax exempt, right? So you don't have to pay taxes on depreciation, right? All right, and then why do we add it back here? Jiyoung, why do we add the same thing back? No idea. Okay. That's right, because depreciation is a non-cash expense, right? Even though you have subtracted this expense from your revenue, actually you did not pay any money for that, right? The depreciation is once you purchase an equipment or invest in something like building, right? Instead of subtracting the entire cost in the first year, you pay or subtract part of those costs, right, over the life of the equipment or life of the building, right? So say you purchased $1 million equipment, right? And if you if the life expectancy of this equipment is 10 years, right, then you can subtract $100,000 or 1/10 of the cost every year, right? That's the rule, right? Accounting rule, right, for the businesses, right? So even though you are subtracting this depreciation, right, actually you have paid all the money up front, either, I mean, if you paid cash for the equipment, right? So this year, there was actually no cash expense, right? But you're simply reducing your income on the book so that your tax liability will go down, right? So in your bank account or in your pocket, actually, right, that money is still remaining, right? So in order to calculate actual cash flow, net cash flow, you have to add it back, right? Does it make sense? Right? So this depreciation, subtraction of depreciation happened only on the book, right? Actual cash flow did not happen, right? So in order to calculate actual accurate cash flow, right, you have to add it back, right? All right? Good. And then finally, you subtract change in net working capital. Ooh. So here, net working capital, why do we subtract it, right? Because initially, net working capital may increase, as I said before, right? Because of the new training or additional inventory, whatever, right? Your net working capital may increase, right? But when the oh, okay, I guess we can come later, right? When the project is finished, let's say this is a five-year project, right? And when the project is completed, then you can recover whatever additional net working capital you have invested, right? You don't need the training anymore, or you don't need additional account receivable or inventory anymore, right? Because you are finishing or closing up this new project, okay? So you have to calculate the difference, how much additional net working capital is required minus how much you recover, right? So if you're talking about let's say 1, 2, 3, 4, 5, 6-year project, okay, then initially you may need some additional net working capital, right? But in the last year, you may actually have net working capital being reduced, okay? In other words, you are recovering whatever additional investment in net working capital you made in the previous years, okay? So just keep that in mind. We'll see actual numbers shortly, okay? All right, this one, before we actually get into the numbers, okay? We're talking about salvage cost, okay? So let's say you're replacing existing equipment, and the sales value happens to be equals to book value, right? Then there is no tax consequence. In other words, in my previous example, right, it was initially $10 million equipment, okay? And over the years, you have subtracted $8 million as depreciation, right? So the remaining book value was $2 million. And actually, suppose you sold this equipment in the market, in the used equipment market at $2 million exactly, right? Then you don't have to worry about anything about the taxes, okay? Because you've already paid the amount of right amount of taxes, okay? Okay. But if the sales value was less than book value, and what that means is you have not depreciated enough, right, over the years, okay? So book value is $2 million, but all you could get in the market was only $1 million. Okay? Then what that means is actually you should have depreciated $9 million so far, right? And get all the tax benefit about the $9 million, but you didn't get enough tax benefit, right? So you will have the tax saving, right? You can actually, let's say the tax rate was 40%, right? Then you can multiply 0.4 here, right? And and you can consider that 40% as the tax saving. Okay? If is the opposite, as I said before, suppose you could get $3 million, even though book value was $2 million, right? And that means you will owe taxes, right? You're 40% of that $1 million, and you will still have to pay taxes on that. Okay? In the unlikely case that sales value was actually greater than cost, initial purchase cost, right? How can it happen? You purchased the equipment, used it for 10 years, right? And after 10 years, you can actually sell it at more than $10 million you initially paid. Is it possible? With the equipment, it may not be possible, but something like building or real estate, right? You know, during the last 10 years, maybe real estate value have gone up so much, right? So even though you have depreciated this building for 10 years, right? Actually, when you actually sell it after 10 years, you can get more than what you paid initially, right? Then it is called the capital gain. Capital gain. Okay? So tax liability will be gain plus capital gain. Okay, so what are we talking about here? Let's say, suppose this was the building, small building, right? And you paid $10 million, and over the last 10 years, you have depreciated $8 million. So the book value was $2 million, right? Right? And then in the market, actually, because of the rise in the real estate price, you could get, say, $12 million, right? Okay. So this capital gain will be, how should you say? Can you separate gain and capital gain in this case? How do you separate? Oh, okay. All right. So obviously 2 million is the capital gain. Right? So out of 10 million, why can't I think of that? Right? So 10 million is the gain, and 2 million is the capital gain. Is that right? No. If you look at the table here, see? If the sale value is greater than whatever, the difference between sale value and book value is the gain.
What do you mean by capital gain?
Capital gain is the asset value actually has gone up, right? So here,
Then we depreciate the asset value?
after the depreciation, okay, your book value is $2 million, right? But in the market, you can actually get $12 million, right? So out of the difference between the purchase cost and this market value is considered capital gain, okay? and the other 10 million is actual gain, right? Does it make sense? Think about it. If you still don't agree, let me know. Okay. So anyway, what's important here is you will owe taxes on entire 12 million. Right? Okay. I think that's how it should calculate. Gain plus capital gain. All right. Okay, let me get on with the. Okay, so here's the recovery of net working capital. The total amount of accumulated net working capital is usually recovered at the end of the life of the project. Okay, so resulting in increase in net cash flow. And interest charges and net cash flow. It is generally considered incorrect to deduct the interest charges associated with. Okay, so what we are talking about here is this. When we use this formula, right, we don't see any deduction of interest charges here, right? Only we are deducting the operating cost and depreciation, right? And why is that? I mean, in the usual income statement setting, right, we subtract the operating cost, right, depreciation, and also before we arrive to the EAT, earnings after tax, right, we subtract the interest charges as well, right? But why don't we see this subtraction of interest charges here? Okay? The answer is, eventually, we're going to discount all these cash flows, right, to the net present value or net present value of net cash flow, right? And when we discount these values, what we're going to do is we're going to use interest rate as the discount rate. Okay? So if we subtract the interest cost from there and then discount again, right, then it's going to be double counting of the interest cost. Okay? Right. So because of the cost of capital, which is discount rate, right, already reflects the cost of funds, whatever, about the money you used to start this project or fund this project, right? The interest charges are being considered by discounting all those future cash flows. Okay? All right, for depreciation, just a kind of side item, right? There are typically two major ways to depreciate. One is the straight line depreciation, and the other is MACRS. Okay? Straight line depreciation is very simple, right? You just divide the total cost. It says installed cost. Okay? So whatever the cost of equipment plus shipping and installation, right? Or the cost of acquiring the new equipment, divided by a number of years over which the asset is depreciated. Usually the life expectancy of the equipment, right? So if you intend or if you expect to use this equipment for 10 years, then you're going to divide the total cost by 10 years, and that's going to be the annual depreciation, right? So that's called the straight line, because if you have $10 million equipment, right, initially, then every year, Yeah? Suppose we have 10-year useful life. Okay? So the value of the equipment or book value of the equipment will be reduced by $1 million every year. Okay? So it's going to be a straight line, okay? Decline of the book value, right? When you do the straight line depreciation. Okay? But more popular depreciation method is in business is called the MACRS, right? It's called the Modified Accelerated Cost Recovery System. Okay? And this is allowed by, I guess, the tax department, I guess, in the United States, IRS, okay? Internal Revenue Service, right? Allows MACRS, and they have specific guideline or rules. Okay? Certain equipment can use 7-year depreciation, certain equipment use 5-year depreciation, and so on, right? And instead of depreciating, say, 10% every year, like the straight line method, right? MACRS allows a lot quicker depreciation. Something like in the first year, you're allowed to have 25% depreciation, right? In the third year, maybe 15% depreciation, right? So you will come to the lower value, book value, much quicker, right? In other words, you can reduce your tax liability, right, in the early life of the equipment, right? Early life of the asset you're depreciating, right? So that works as a benefit for businesses, right? Because they can reduce the tax liability or taxable income. Okay. And last semester we talked about this, but in businesses there is a certain trick, right? So if you continue to purchase the new asset every few years, right? Then, eventually, this difference has to be made up, right? Like this, right? Because ultimately, the value of the asset has to be depreciated to zero, right? So the MACRS, the only benefit is you get to depreciate it a lot quicker in the first few years, right? But in the later years, your tax benefit will be reduced, right? So eventually, you'll have to come to zero anyway, right? But if you keep making investment in the new asset, right, then you can continue to have this difference. In other words, you can maintain the tax benefit, right? And basically, you are not going to be required to pay the back taxes that you owe, right? So that's the benefit of MACRS. Right? Okay. So here, some numerical example of how we handle the depreciation. Okay? So suppose we are using straight line depreciation here. The revenue of $1 million, the operating cost of $500,000, and you subtract the depreciation. Okay? You have to understand that we're talking about actually all these numbers should be incremental basis, right? So change in revenue, change in operating cost, change in depreciation, and so on, right? According to our discussion, right? So from $1 million revenue, you subtract $600,000 as the cost and expense, including depreciation, right? So you come up with the $400,000 operating earnings before taxes. We're talking about additional earning, right? Coming from the new project, right? And you owe 40% taxes on it, right? So after taxes, your operating earnings is $240,000, right? And there you add $100,000 depreciation back, right? What you have subtracted here you have to add it back here, right? So that your actual cash flow will be accurate, right? Whatever actual money you have made or you have kept in your pocket, right? Accelerated depreciation may allow $150,000 depreciation instead of $100,000 depreciation, right? So there's a slight difference here. As you see here, your tax liability decreases from $160,000 to $140,000, right? So even though your operating earnings after taxes is smaller with the MACRS, when you add the depreciation back, which is actually a non-cash expense, right? That's the fake expense. You did not actually spend this money, right? So your net cash flow is larger, right? If you use MACRS, right? Make sure you understand that idea, right? Any questions so far? All right. I'm sure it's a little bit confusing in some areas, but here's the example, right? And you will feel a lot better after this example, right? So let's say you have an asset expansion project, right? So we're not replacing any equipment, but you're simply adding a new equipment, right? And the new equipment costs $50,000, and there is a shipping and installation charge of $5,000. So total installation cost is $55,000, right? Now, it will be depreciated on a straight line basis over 5 years, right? So that means the annual depreciation is what? 55,000 divided by 10, right? So what? $5,500 will be annual depreciation, right? Oh, I'm sorry, 5 years, sorry. So, yeah. So 55 divided by 5 is 11,000, right? 11,000, right? Okay, so 7,000 increase in net working capital at the beginning of the project, right? That's just a given. Okay. And then the total revenue will increase by 50,000 above the level that would have prevailed in year 1, okay? So we're talking about that's the additional or change in the revenue, okay? And the change in the revenue in the second year would be 60,000, and third year 75,000, and then the fourth year it goes back to 60,000, and the last year, in the fifth year, it will be 45,000, right? Additional revenue, okay? And how about the operating cost? Operating cost increases by 25,000 during the first year. And then after that, it increases at the rate of 6% the rest of the life of the project, right? Depreciation will be 11,000. We already calculate that, right? Marginal tax rate is 40%. And net working capital will increase by 5,000 per year in 1, 2, 3. And there will not be any additional net working capital requirements during the years 4 and 5. Okay? But at the end of the project, the total accumulated net working capital will be recovered. Right? So these are the assumptions. These are the facts about this investment. Right? All right. So first step is you have to calculate the net investment. Okay? Net investment is the cost of the equipment plus installation charge plus additional net working capital. So total net investment comes 62,000. Okay. And then we calculate the net cash flow for each year, okay, according to those assumptions. Okay. So in the first year, the revenue increases by 50,000, but the additional operating cost will be 25,000, right? And from that, you subtract the depreciation and multiply by 0.6, So that's after-tax earning, after-tax operating income, right? And from that, to that, you add 11,000 depreciation back because we're trying to calculate the cash flow, right? And then finally, you subtract 5,000. What is this 5,000? Change in net working capital, right? So according to the story, in the first year, you require $5,000 additional net working capital, right? So you have to subtract it, right? So net cash flow for the first year is $14,400. The second year and third year, you will do the same thing. The last year, you have the same thing up to this point, right? The last one here, right? Here, you're supposed to subtract change in net working capital, right? But change in net working capital happens to be negative 22,000. Why? Where did that number come from? Yeah, that's the accumulated net working capital, right? So according to the story, okay, here. Initially you have to spend $7,000 additional money on the net working capital, right? And then during the first 3 years, years 1 to 3, you need to spend $5,000 additional net working capital, right? So 15,000 plus 7,000, that's 22,000, right? Total accumulated net working capital, right? But when the project ends, right, you're going to recover that additional net working capital you have spent, right? So you end up adding, right? So all this, you end up adding 22,000, right? So the cash flow for the last year is 34,463. Okay?
Sir, but
Yeah.
I wonder why do we have to accumulate
Net working capital? Yeah. The idea is because of this project, you needed to keep a little more cash, right? Or a little more account receivable or inventory, right? But when the project ends, you don't need those things anymore, right? So you can reduce the amount of account receivable, reduce the amount of inventory, right? Or amount of additional cash, right? So that's what we're talking about, recovery of accumulated net working capital, right? Yeah, yeah.
Then is all the figure depreciated to the present value?
Yeah, that's the next step, right? So here we have the whole table here, right? So we have year 1, year 2, and so up to year 5, right? So we have this timeline, right? Initial net investment is 62,000, right? And then we have this future cash flows, right? So if you want to calculate the net present value, right? Then you have to discount all this future cash stream, right? Like this, right? Discount all the cash flows, okay? And then subtract net investment from the total present value of net cash flow. Then you will come up with the net present value. Okay? Right? Well, I'm sure you know how to do that. So we're talking about present value of NC net cash flow 1 is what? 14,400 times PVIF, present value interest factor, whatever let's say 6% annual interest rate, right? I don't think the textbook gives any interest rate here. But let's say currently the market interest rate or cost of fund is 6%, right? Then 6% for 1 year, right? The PV net cash flow 2 is what? 19,500 times PVIF 6% for 2 years, and so on, right? That's how you calculate the present value of all the cash flows, right? Okay, so all the cash flows are entered. Now she needs to enter interest rate, right? 6%. And then all you need to do, orange key, right? Orange key and NPV, right? So the net present value apparently is $35,000 and $670.58. Thank you, Angie, right? So yeah, if you use the calculator, you can calculate all this uneven cash stream quickly, right? You don't have to look up the tables for PVIF. In my class, when you take the test, I don't hand out the tables, okay? So you're supposed to use calculator rather than the table, the present value or future value tables, right? Because nobody uses the table in reality, right? Those tables are not accurate, right? Because they are rounded up from the fourth digit, right? So if you're dealing with the millions of or 100 millions of dollars, it makes a lot of difference because those numbers are cut off after the third digits, below the decimal point. Okay? So my recommendation is you either get the calculator or download the calculator app on your cell phone, on your mobile phone, okay, and get used to it. Okay. All right. I guess we should stop here today, and we're going to finish this chapter on Thursday. Any question? All right. I'll see you on Thursday.